Hello and welcome to Core Finance. I'm Matt Brown. I'm joined by Alessio Rastani, who is the founder and CEO of leadingtrader.com. Alessio, thank you for joining us today.
Thank you.
What are we going to look at this morning?
I thought I'd give a share, as opposed to talking about a specific market today, I just want to share with your viewers something interesting about the patterns that form on a chart and how you can use them to your advantage. So I want to talk to you guys about a pattern that repeats itself. Guys, if you just go to the next chart before we come back to this one. Yeah, so I'm going to start with this one. According to something called Elliott wave theory, and for folks who are not familiar with Elliott wave theory, according to Elliott wave theory, most corrections are formed of three segments. And what that simply means is if you see a move up in a market, usually you see a correction. And this correction is usually formed of three waves or three segments. And I've got an example here. So you can see, take a look at this chart. This could be any chart, by the way. It could be a stock market, it could be a currency, whatever. And if you take a look at those corrections, the corrective moves that I've drawn there, you can actually make out three segments, three sections. And it takes some getting used to visually. At first, it doesn't snap out of you, but once you see it, you can never forget it. And take a look. You see that these corrections, these three-wave corrections, usually tend to complete at the 100 moving average. I recommend your viewers always put the 100 daily moving average on the chart, which, by the way, the 100 moving average usually is about the same level as the weekly 21 moving average, so the two usually are in unison. Not always, but most of the time. Now you're probably wondering, well, if your folks are, viewers might be saying, so what if it's three waves? How does that help us? The way it helps you is this. If you know that the third wave, what's called a C wave, it's about to complete. So if you see a move down from an uptrend, if you see a move down to the 100 simple moving average, and you see three waves have been forming since then, well, guess what? You can use that as an opportunity to get long when you get a trigger. So you can actually position yourself, get prepared for going long on the market when that C wave is about to turn around and complete. You can use triggers.
How would you prepare yourself? You say triggers.
You can use different kind of indicators, momentum indicators, but essentially just be prepared, because that usually when the third wave is about to complete, that means that we're about to start a new wave higher. By the way, the same thing applies in the reverse. So if we take a look at the previous chart, guys. Yeah. So if you get a downtrend, if the market's moving lower, be prepared for a corrective move, like a pullback or a bounce. And that pullback or bounce usually takes you, again, either the 21 moving average or the 100 simple moving average. But bottom line is, the fact is that those corrections, again, as you can see here, are formed of three segments, three waves. When those three segments are about to complete, again, you can use a trigger to get short. Take a look at this. You'll see you can actually got short there. You could use any kind of trigger to essentially go in the same direction as the original move. So the way this helps your viewers and the way it helps traders is that, look for this pattern. Whenever you see a corrective move, look for three segments, look for three sections, the ABC corrective waves. There's a trader I know in America, all she cares about is this ABC pattern. That's all she cares about. She just waits for that, and it's okay. And I think that's a great idea, what she does, which is that, wait for that ABC corrective wave to complete, and then she looks for a potential entry point into the market to go in the same direction. So that's
And it's interesting, if we're looking at this downward trend, I mean, you could say at any point, you could be short and you'd profit, because it is a downward trend, and we're looking at the moving average. That's fine. But by looking at this wave pattern, what you're doing is highlighting the points where you can maximize yourself, because you could sell at the bottom of the first wave on the A, but if you sold on the C, your profits would be large.
You're absolutely right, man. That's exactly a good way of putting it.
Fantastic. Well, thank you very much for bringing your insight onto the show. Really do appreciate that, Alessio.
Thank you. All right, guys, I hope this video has helped you, and if you found it to be informative and educational, please give it a thumbs up, and also please remember to subscribe to our videos for future updates. Thank you very much.